business segment, business field with respect to company's profit or contribution margin. Here, see.
Sir?
Yes.
Can we start? Do we have the product costing concept?
Yeah.
Okay.
See, after controlling profitability analysis, we start integration. After that, SD integration. Then we start product costing.
Oh, okay, sir.
Because into the product costing, the information is also transferred from also.
Oh, okay, sir. Thank you, sir.
So profitability analysis enables the group management to evaluate the market segments. Market segments means the markets which can be divided on the basis of products or customers. We can analyze the profitability of the company. Here, remember, we can analyze the profits of the company. We are not finding out the profits. Using the COPA, you can analyze the profits of the company according to products or product groups or customer groups or sales offices or any other criteria required by the management. It is the process of analyzing the profits. It's not the process of finding out the profits. If you want to find the profit, right, we have the profit center account. But here, I want to analyze the profits. Analysis of profits means analysis of profit elements. Say, for example, right, we have the different customer groups, and we have the different product groups, and we have the different sales offices, and we have the different sales districts. Now, as far as customers groups are concerned, right, we have 25 customer groups. Then for each customer group, the management wants to know what is the total sales revenue. The management wants to know what is the total sales quantity. What is the total cost of manufacture for each customer group. Then what is the cash discount available by every customer group. Then what is the cost of goods manufactured for every customer group. So for each customer group, the management wants to know these values. This is called analysis of profits. Similarly, for each product group, what is the sales revenue? What is the sales quantity? What is the direct cost of material, for example? What is the cash discount paid for each product group? And what is the cost of goods manufactured for each product group? Then for each sales office, you have the Northern Sales Office, Southern Sales Office, Eastern Sales Office, Central Sales Office, etc. Then for each sales office, what is the total sales revenue? What is the quantity you have sold? What is the cost? What is the cash discount given to customers relative to every sales office? And what is the cost of goods manufactured? So this is called analysis of profits, analysis of profit elements, right? So in the profit center accounting, you can find the total profits, but here in the COPA profitability analysis, we can find out, we can analyze the profit elements according to the criteria required by the management. So in this case, here the customer group, product group, sales office, sales district. This is only an example. These are called characteristics. Then the sales revenue, sales quantity, cost, cash discount, COGM. COGM means cost of goods manufactured are called value fields. So in the COPA, what exactly we do as a consultant? And the combination of characteristics and value fields is called data structure. So in COPA, as a consultant, we create as many number of data structures as required by the management. Based on their reporting requirements, we create as many number of data structures as required by them. Then we do some settings whereby whenever and wherever the relevant values are posted in any module in SAP, these values will be taken and stored into these data structures. The values will be stored in the data structure. Then we design number of reports. Whenever the user executes the report, right, the system will take the values from these data structures and those values are presented in the report. This is simply the function of the COPA. That's it. But we have to do number of settings. So data structure, it is the combination of characteristics and value fields. Characteristics means this is the criteria for which the management wants to analyze the values. It is the criteria for which the management wants to analyze the values, like customer group, product group, etc. We can also define our own characteristics in addition to the system-defined characteristics. The user-defined characteristics should start with WW. Here, these are the characteristics, and these characteristics were already defined in the system. There are many more characteristics out there, but I have taken the examples of only 4 characteristics. So there are many characteristics already defined in the system, and if necessary, we can also define. We means consultants. The consultants can also define the own characteristics according to client reporting requirement. But the user-defined characteristics should start with WW. Then value fields. These are the profit elements which management wants to analyze for every characteristic. Example, sales revenue, quantity, etc. Here, for this characteristic, the management wants to analyze these values. These are called value fields. Okay. And again, there are many more value fields. We can define our own value fields in addition to the system-defined value fields. So the user-defined value fields should start with VV. The word is missing there, VV. Should start with VV, V for Victor, VV. Now you strike off these 3 sentences. After that, you strike off these 3 lines. By mistake, I have repeated them. We can also define our own characteristics in addition to the system-defined characteristics. The user-defined characteristic should start with VV. Strike off these 3 lines. The user-defined value fields should start with VV, and the user-defined characteristics should start with WW. How to define our own characteristics, I will show you by configuration. Then, it's very important from the entry point of view. The differences between profit center accounting and profitability analysis. See, focus. In the profitability analysis, right, the focus is mainly on external market segments. Means the markets divided according to product groups, sales customer groups, etc., etc. So the main focus is on analysis of profits on the basis of external market segments. But in the profit center accounting, the main focus is on internal responsibility centers or internal areas of activity. Then reporting. When it comes to reporting, in COPA, we can we can generate the reports at any point of time. And the report, it reports on contribution margin. Then in the profit center accounting, generally the reports are generated at the end of the period. And we can report on the profits and loss statements. What is contribution margin? What is contribution margin? Here, see, the cost of any product contains fixed cost and variable cost. The cost of any product contains fixed cost and variable cost. So, sales revenue minus variable cost is called contribution margin. Sales minus variable cost is called contribution margin. So, the contribution margin contains the fixed cost plus profit. Why this type of analysis is required? Here, you have started a new business, right? So, at what point we will break even? Break-even point means it is the level of activity where there is no profit or loss. Here, Fixed cost means what? You have established your business concern, right? So whether you run your business or not, that fixed cost you have to pay. There is no other way. The fixed cost you have to pay in any case. Whether you do the business or not, you have to pay the fixed cost. So in any case, right, you have to meet your fixed cost. Now, you have started your business, you have done the production, and you are selling the goods. The variable costs are incurred only when you carry on the business. Then, sales revenue, your profits should be at least equal to your fixed cost. When you start your business activity, right, your profits should be at least equal to fixed cost. If you cannot meet your fixed cost, you incur the loss, right? So, for the purpose of finding out the break-even activity of a business enterprise, we require contribution margin. So, the contribution margin is always sales revenue minus variable cost. So, the profitability analysis always reports on contribution margin. So, contribution margin means fixed cost, it includes profit also. Contribution plus profit. Sorry. Fixed cost plus profit is your contribution margin. Contribution margin minus fixed cost is your profit. So this type of analysis is done in the COPA. But in the case of profit center accounting, there is no concept of contribution margin. We straight away report on profits, net profits. Then, method of accounting. In the case of COPA, we use cost of sales accounting method. Then, in the case of profit center accounting, we can use both methods of accounting. That is cost of period accounting and the cost of sales accounting. What does it mean? See, what is cost of sales accounting and what is cost of period accounting? Right? Some of you might have heard about it. See, cost of period accounting. In the case of cost of period accounting, right, you take into consideration all the expenses incurred in that particular period. And they are compared with the revenue generated in that period. So normally, legally also, always we have to follow the cost of period accounting. So in the cost of period accounting, right, you take into consideration all the expenses incurred, in the month, and also you compare those expenses incurred with the revenue generated in that period. That means, say for example, you have produced 1 lakh units in this month. In the month of March, you have produced 1 lakh units. And the total cost of production is 1 crore. Your total cost of production is 1 crore. Right? Now, total output is 1 lakh. So what is the cost per unit? 100 rupees. Now, you are selling each unit at 120 rupees. And you have sold only 80,000 units. You have sold only 80,000 units. So in this case, how you are calculating your profits? What is your sales revenue? 1 crore 60 lakhs plus closing stock. And the closing stock is evaluated at the cost of production. From that total, you reduce the expenditure of producing 1 lakh units. See, you have produced 1 lakh units, right? Out of which you sold 80,000 units, at 120 rupees per unit, 1 crore 60 lakhs. Sorry, 9 crores in 96 lakhs, right? 120 rupees into 80,000 means 96 lakhs. For that sales value, you are adding the closing stock at the cost price. That means what? Your credits are understated. In the P&L account, your credits are understated. Now, this sum is compared with the total cost of producing 1 lakh units. Are you getting the point? That means what? In the case of period accounting, the profits are understated. Right? Now, these profit figures are not acceptable to sales department. What the sales department argue is, how can you compare the sales revenue of 80,000 units with the cost of production of 1 lakh units? It's not, it is illogical, right? So we don't accept these profit figures. Then actually what the sales department will argue is, you have to compare the sales revenue of 80,000 units with the cost of production of 80,000 units only. Then only we can analyze our performance. Then only we can see our performance. That means, right, in the cost of period accounting, always we consider, right, the opening stocks and closing stocks, which are evaluated at the cost price. But in the case of cost of sales accounting, always you consider the cost of production of sold units with the sales revenue derived from the number of units sold. That is the difference. So in the case of COPA, right, we always follow cost of sales accounting method. But in the case of profit center accounting, always we follow cost of period accounting normally. But technically, we can also use cost of sales accounting also. So what is cost of period accounting? The period accounting approach distinguishes between individual costs and revenue elements, such as material costs. The total costs for the period are compared with the total revenue for the period. The output of the products means the production of the products manufactured within the period but not sold, stock increases, are added to the sales revenue. We are showing the closing stock on the credit side means what? We are showing the closing stocks on the credit side, the P&L account. That means what? Sales is also shown on the credit side and closing stock is also shown on credit side, right? That means what? The closing stocks are added to the sales revenue at the cost of production. The output of the products manufactured within the period but not yet sold, that is stock increases, are added to the sales revenues, and the cost of the products produced in the past periods but sold in the current period, that is stock decreases, are taken away. Simple. On the credit side, you are showing your closing stocks and sales. On the debit side of the P&L account, you are showing your opening stock. That means what? Opening stocks are reduced from the sum of sales and closing stocks. Together with additional capitalized internal activities and other revenues, this yields the total operating profit for the period. That's what I told. In the case of cost of period accounting, we consider the closing stocks and opening stocks in addition to sales. Then, in the case of cost of sales accounting, there is no differentiation according to cost elements. Here, the sales revenues are compared with the manufacturing costs for the product sold. As simple as that. The sales revenues are compared with the manufacturing costs for the product sold. The manufacturing costs may include material, personal costs, which are incurred in the previous periods. Costs which cannot be directly assigned to the sale, such as sales and administration costs, are displayed separately. The cost of sales procedure, therefore, also indicates whereabouts in the company costs are incurred. That means here, cost of production or cost of goods manufactured. What is cost of goods manufactured? Direct material cost, direct labor cost, factory overheads, administration overheads. This is cost of goods manufactured. For the cost of goods manufactured, right, we add sales and distribution expenses incurred in the sales department. That is called cost of sales. So the sales and distribution expenses are incurred only when you sell the goods. That's it. If you don't sell the goods, right, there is no sales and distribution expenses, right? That's why we separately again report on cost of sales. Then there are two types of profitability analysis. Number one, costing based profitability analysis. Number two, account based profitability analysis. In the costing based profitability analysis, the costs and revenues are grouped according to quantities and values stored in the value fields. It is useful for the short-term analysis. That means here, in the case of costing-based analysis, costing-based profitability analysis, always we use the value fields. Here, revenue is created as one value field. Sales deductions will be created as one value field. Variable material cost is one value field. Variable production cost is one value field. Production variances as one value field, like that. So revenue 1,000 less sales deductions. Sales deductions means the expenses incurred in the sales and distribution department, or the expenses which have the impact of reducing your sales revenues. Then 900 is the net revenue. From the 900, material cost 400, variable production cost 190 rupees, production variance is 10 rupees. So all these are created as value fields. So contribution margin 300 rupees. So from the contribution margin, production overheads 60 rupees. Material overhead 60 rupees. Production overheads 40 rupees. From 300, you reduce this material overheads and production overheads. Contribution margin 2 is 200 rupees. What I mean to say here is, what you have to understand is, in the case of profitability analysis, the value fields are used. So when you use the costing based profitability analysis, we can also report on the quantities also. Because in the controlling, always we maintain the quantities also, right? So in the costing based profitability analysis, right, we can get the information regarding the quantities, and also the information is extracted from the controlling records. Do one thing. Yeah, it was maintained. It was mentioned somewhere else, the material also. Okay. So in the course of costing based profitability analysis, the information is extracted from the controlling records or controlling documents. So in the controlling, always we can maintain the quantities. No? So we can analyze the quantities. Then in the costing based profitability analysis, always we use value fields. Then in the case of account based profitability analysis, in this type, the data is captured in the GL accounts as against the value fields in the costing based COPA. So in the costing based COPA, right, the information is extracted from the value fields. But in the case of account based COPA, the information is extracted from the GL accounts maintained in FI. For example, how the revenues are represented through GL account, 3 lakhs. So these GL accounts are created as cost elements, right? Then sales deductions. Sales deductions means expenses which have the impact of reducing your revenues, right? So for every sales related expenses also, we maintain the GL account. So revenue 3 lakhs GL account and the amount 1,000. So how this 1,000 amount sales is taken to COPA? Through GL account only. And how this sales related expense of 100 rupees is taken to COPA? From this GL account only. 4,320. Then price differences, marketing expenses, other expenses. Every expenditure is also taken to COPA through GL accounts only. That means what you have to understand is, in the case of account based COPA, the information is extracted from the GL accounts in FI. So in FI, can you maintain the quantities anywhere? No. So when you use account based COPA, you cannot report upon the quantities. It is possible to report on quantities only in the costing based COPA. Here. So the difference between costing based COPA and account based COPA is what? Number one, in the costing based COPA, right, the information is extracted through value fields, and in the costing based COPA, you can report on quantities also. In account based COPA, information is extracted from the GL accounts in FI, and we cannot report upon the quantities in account-based COPA. These are the two differences. In addition to that, there are some more differences. Differences between costing-based PA and account-based PA. PA means profitability analysis. Quantities and values are stored in value fields. In the case of costing-based COPA, quantities and values are stored in value fields. But in the case of account-based COPA, the information is stored in GL accounts. That is, quantities and values are stored in GL accounts. Then, costing-based COPA is useful for the short-term profitability analysis, and account-based COPA is useful long-term profitability analysis, and they are permanently reconciled with the FI data. Whatever the information you get from the account-based COPA, it is always reconciled with FI. It is always equal to FI records. Why? Because the information is taken from GL account balances only. But in the case of costing-based COPA, sometimes you may have to do the reconciliation. Why? Because all the expenses may not be treated as cost elements. Then, the timing at which the information is updated in COPA and the profit center account. When updating happens in profitability analysis, the value field COGS. See, COGM means cost of goods manufactured. COGS means cost of goods sold. So the value field cost of goods sold is updated when the billing document is created in SD. Here, the profitability analysis is closely related with SD module. So for the time being, remember these points. That's it, right? What is billing document? That we will discuss in SD integration. But for the time being, you just remember these 2 points. That's it. The value field COGS is updated when the billing document is created in SD. There is one business process in the sales and distribution which is called order to cash. In that order to cash process, right, billing is one process. So when we generate the billing in SD, then only the cost of goods sold is updated in the costing based COPA. That is, the revenue, discounts and freights are updated at the same time. But in the case of profit center accounting, the value field COGS is updated at the time of delivery of goods in SD. So delivery happens before billing in SD. So in the case of account-based COPA, right, the field cost of goods sold is updated before the costing-based COPA. So delivery happens before billing. So in the case of account-based COPA, the cost of goods sold field is updated at the time of delivery of the goods itself. But the discounts and freights are updated when the billing document is created. Only the time difference is with relates to cost of goods sold. So in the case of costing-based COPA, cost of goods sold is updated at the time of billing document. And in the case of account-based COPA, the value field cost of goods sold is updated at the time of delivery document. For the timing, remember these 2 points. That's it, right? You may not be able to understand at this point of time, but later in SD integration, again I will take the reference of these fields and again I will explain. Then COGS may be understated sometimes, but it is overstated sometimes in the profit center. This is all necessary, right, from the interview point of view. Then timing of profitability analysis updation in the costing based COPA and account based COPA. COGS, cost of goods sold is updated when the billing document is created in SD module, and the account based COPA, the cost of goods sold is updated at the time of creating delivery document. FI expenses, same time, at the time of posting in FI and at the time of posting in FI. When we post expenses in FI, these will be updated in the costing based COPA and account based COPA at same time. Then freight, when the billing document is created in SD module. Similarly, account based COPA also when the billing document is created in SD module. Then expenses posted internal order at the time of settlement, Then revenues, when the billing document is created as SD module, then the billing document is created in SD module. So all the expenses are updated same time in the costing based COPA and account based COPA, except COGS. COGS, cost of goods sold, information is updated in the costing based COPA at the time of creating billing document. But in the case of account based COPA, it is updated at the time of delivery. Then the remaining things we will see tomorrow, right? Characteristics and all these things we will see tomorrow. Tomorrow also we have the class at same time, 6:31. Okay, then see you tomorrow.